Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Indranil Pan, Chief Economist at Yes Bank, joining in. Welcome to the show, Mr. Pan, and always a pleasure to speak to you. Mr. Pan, overall, if you go to see right now with what the RBI has done, they've maintained their stance. They have maintained the rates as well. And this is the sixth consecutive session where the rates have not changed. Do you think the RBI right now is in a tough spot? Because if you look at over almost a 2 year period, we've got GDP which is lower than it was 2 years ago. Inflation is over the last 2 years has grown at about almost 5.6% or 7% on a compounded annual growth basis. Taking these parameters into consideration, how would you describe the entire scenario?
Well, I'll pick your point as to whether the RBI is in a tough spot. Probably yes, because the growth inflation generally has to move in the same direction for the policy to be sort of in one particular side or the other. Today, what they are seeing is risks to the growth. Growth, anyways, is coming down. They themselves have downgraded their growth estimates, while the inflation either remains sticky or is slightly on the higher side. Now, the brave face that the RBI is putting out today is that there is not much of a demand that is there in the economy. And yes, there is some supply side pressure on the inflation. But because demand is not there, the supply side pressures will not possibly, or the higher output, higher sort of input costs from the metal prices and oil may not actually fully transmit itself to the inflation. So that's the way the RBI is looking at the data, and therefore wanting to see through the current stickiness and the firmness in the inflation. And the whole sort of monetary policy is geared towards the GDP and how they can actually revive the economy. Now, very honestly, therefore, their stance is clearly a state-based stance, which is basically clearly saying that we are there to do whatever is necessary till there is a durable recovery in the economy. So I think yes, the RBI is in a tight spot. And you just talked about six consecutive meetings where they have not done anything on rates. I think it's a long, long time before any central bank around the world is able to do anything on the rates, because there will always be a fear whether they are taking the sort of liquidity bowl, or even from a rates perspective, earlier than anticipated, which might actually precipitate another round of slowdown.
Right. So overall, if you go to see, would you say that it's a pretty good balancing act that has been done by the RBI? Because clearly, I think right now the focus of the RBI is to look at growth, and probably it will be really premature to talk about policy normalization.
Well, I'll try and answer this question in a slightly different way. Uh, now, the one of the critical things I think is that is in front of RBI at this point in time, and possibly also the government, is to keep the supply side alive. So the point that I'm trying to make is that it shouldn't be a case where a certain segment of the supply side is starved of liquidity, starved of credit from the banking system, and therefore dies an automatic death. So that will be a harakiri so far as the progress of the economy going forward is concerned, as also would probably lead to higher inflation in the days ahead if the supply side comes under the severe strain. So I think what the RBI is trying to do at this point in time, yes, they have an adequate amount of liquidity in the system, but the channelization of of this liquidity to the right places is what the RBI is looking at. And to that extent, they are also trying to therefore incentivize the banks to lend to these sectors, which obviously are risky sectors at this point in time. For example, if they've talked about the contact based industry, nobody has a clue as to when this pandemic will end. When will people once again start traveling? When will the hospitality industry come back to strength, and sort of even to the pre pandemic days? and that's what they are possibly looking at. So they are looking at more from the side of distribution of the liquidity at this point in time, rather than providing liquidity to the system. So they've all central banks around the world therefore have moved away from traditional policy making, which is rates and liquidity and whatever, and into more non-traditional areas. People started with quantitative easing, but now we have actually dropped ourselves or moved ourselves into a situation where the distribution of the overall liquidity is of paramount interest and importance rather than anything else for any central banker around the world.
So basically, Mr. Pan, is it right to say that, now the monetary policy has done what it needs to do, and everything now depends probably on the fiscal side of the policy?
Uh, it's a very difficult question to answer. In the sense, yes, fiscal policy needs to step in, but unfortunately, you don't have any leeway from a fiscal policy perspective. So the fear is that, anyways, debt is on the higher side. The general government debt is also already almost around 90% of the GDP. And if interest rates are not in check, and if growth doesn't pick up, I'm more talking about the nominal growth rather than the real growth, then servicing this debt over the years may actually become a huge problem for the Indian economy. So, while we all understand and realize that the fiscal policy needs to step up, where is the room for the fiscal policies to step up? And therefore, the next question is, if the fiscal policy steps up, according to the traditional economics book at this point in time, whether you are actually landing yourself up in a situation which might actually turn out to be more disastrous than the current period. So, therefore, the strategy for the central government perspective is clearly on the capital expenditures, which is in their hand. And I think the finance ministry is also asking most of the other ministries to improve their capital expenditure. Capital expenditure had suffered significantly in the first quarter because various states and localities, etc., were under a lockdown. So that will come back on stream, and that will provide some benefit in terms of showing up as growth. And my bet is that the central government is sort of pinning their hopes on the fact that this will probably lead to some amount of employment generation, and therefore growth will be relatively more durable and stable going forward, rather than trying to push consumption, which anyways has a very short period of durability in terms of how the implications of that is felt in the economy. But having said that, I think one of the bigger issues that the government needs to probably look into very carefully now is how logistics costs are panning out in the economy, and whether that is having a very sensible impact on not only the mobility of the people, but also their ability to spend on items which are even essential items. So I'm basically talking about petrol and diesel, which has a clear implication in terms of how I, as an individual household, would be looking at sort of allocating my share of income into various categories. And that, to a certain extent, might actually lead to a drop in my expenditure for some categories of products, including maybe the essential. Uh, uh, b- so that is something that really is open to the government, whether but they can sort of take a bet and give up 5 rupees from their revenue. Probably the center has to give up the revenue more than asking the state governments to actually give up their revenue, because the states are in a worse fiscal condition than the center, with limited artillery to correct it for themselves. So I think these are some of the fiscal push or the measures that can be looked at, which might actually help the consumption demand.
Right. But with this, Mr. Pan, one question I have is that during the first wave, a lot of us were looking at the rural side of business, saying that yes, rural is not impacted, that's what is going to support the economy in this point at this point in time. However, if you look at the second wave now, a lot of rural India has been impacted, and it's in a bad way. Now, do you think that could impact the spending ability overall? And clearly, the story of the pent up demand that we'd seen in the first wave, that's something which could be missing now and could impact growth overall.
So I think you're asking two questions here. From a pent-up demand side, I think the urban is more important than the rural.
Hmm.
And in this second wave, I think the medical expenditures have been much enhanced from the urban category. And people like you and me may not have been severely impacted. Even for instance, God forbid, we have to spend about 5 lakhs for treatment of myself or any other family member. But there are certain categories of people, even in the urban area, which will be severely impacted if there's a 5 lakh cost that comes to them suddenly. So definitely the discretionary part of the consumption will be down from the urban perspective. In terms of the rural perspective, I think what is clearly evident is in the data today is that the spread of the virus, as you rightly said, is much wider in the rural areas. But if I look at the CMI data on jobs, the rural segment's salaried employment has actually taken a big hit in this round than anything else. So from their perspective, also the discretionary income will probably be lower. Now we come to the more essential consumption expenditure. And this is possibly, this has been relevant from even the first cycle. Now just imagine a migrant worker, and for example, if he probably would have been earning 100 rupees per day in the urban area, he was giving back 50 rupees to his village and people in the village. So there were two sets of consumptions that were happening. One with the 50 rupees that remained with him in the urban area, with him, and the other 50 rupees which was sustaining his family in the village. Now, if the same guy would have migrated back, and data shows that rural salaries are actually about one-fourth than in the urban, and assuming that this guy even has found an employment in the rural segment, his salary would have actually become that much smaller. Now, even for an instance, if I assume that his salary in the rural economy is, say, a 50 rupees. So, with the 50 rupees, he is now actually sustaining his whole family, including himself. So, you can imagine the amount of hit that might actually have happened to this family and household out of the very fact that this migrant worker has shifted back. And
Hmm.
given the fact that you have the second wave, not all migrant workers have come back, and there is still a strain in terms of how migrant workers would be looking at coming back to the urban areas and getting employed again. And now for perspective, I think obviously there's no data on this, but what
Hmm.
I've been listening and hearing is that this time the visibility of migrant workers going back is not there, simply because most of the local transport, trains and everything is working. So you don't see them going back, or you don't hear them walking back on the road painfully, but they are still possibly they have once again lost their jobs here, and they are actually once again getting back to their hometowns.
Right. So, Mr. Pan, what would your growth outlook look like if you have to look at FY22? Because the RBI did revise down the GDP growth number to 9.5% from a 10.5% earlier, taking into consideration how the urban demand could be dented, how rural could be impacted, and how inflation is playing out. Do you think, from your perspective, you would be lower than the RBI projections?
Uh, we are at an 8.5%,
Hmm.
and very honestly, we were never at a double digit on the growth front at any points in time. Uh, Now, a lot of literature on these growth, backing these growth numbers has been that Q1, Q2, Q1 is basically the lockdown phase, and most of the states are opening up now. By the middle of June, by the end of June, everything will be open and everything will be hunky dory. Yes, it may be, and therefore some of the lead indicators that we generally look at, which is basically mobility and etc., etc., might come back. But all the while that we talked about how consumption behavior might actually be dented in this round of the virus than in the previous round, I think there continues to be a pain into Q2 and Q3, and that too assuming that there is no third wave that actually sort of hits us once again and closes down certain segments of the business. The
Right.
other important thing to note when
Mm,
we talk about pent-up demand is that in the last cycle, there was a significant reduction in interest rates that happened. And that probably gave the overall consumers some hope and belief, and therefore they stepped back into consumption of the discretionary items. In this time around, the affordability from the pure perspective of the lending rate of global of the sort of banking system having come down is not there, and that's possibly another reason why the pent up demand
mm.
might be missing, and that will be an implication for growth on the lower side rather than the higher side.
Right. And Mr. Pan, on the inflation front as well, CPI we are projecting at almost 5.1% for FY22. And clearly, Dr. Michael Patra as well had mentioned in the press conference that RBI will continue to look through inflation until it sees demand side pressures on inflation. And currently that inflationary pressures are largely emanating from the supply side. So do you think even any act the government does to exclude the supply side pressures is something that would help?
Uh, well, that's what possibly I say the RBI and the government is trying, and therefore the distribution of the credit to the right channels is what is the most important thing at this point in time. Obviously, the other point that I mentioned is whether the government is now ready to give up 5 rupees on, say, a petrol as also on diesel, which will bring down the pressure from the logistics costs, and that to a certain extent will help the food inflation even, because a part of the food inflation is also the logistics cost. In terms of the global sort of metals that is possibly hitting us, fortunately, the RBI's mandate is to look at the CPI and not the WPI. So that's the reason you see a huge wedge that is built up between the WPI and the CPI. And for the next round of readings that will come out on the 14th or the 15th, I think Monday, we do expect the wedge to have widened.
Hmm,
But again, the fact of the matter, as you rightly said, is whether there is a demand pull. If there is no demand pull, then possibly to a certain extent, the larger manufacturing houses would be ready to absorb some of these pressures themselves. And that will be a hit on their bottom lines
hmm,
rather than anything else. It will not show up in your headline CPI. And as demand recovers in the economy, these companies will then get the scope of passing on the higher input costs to the end users. And that is when the inflation is likely to rise. And that's exactly, I think, what the RBI is pointing out to.
right. And with this overall on the liquidity front as well, uh, clearly during FY22, the RBI has undertaken regular OMOs. They have the GSAP 1.0, in addition to that, and a GSAP 2.0 that has been announced for the second quarter of FY22. Now, with this liquidity infusion that we are looking at, what's the kind of impact do we see with regards to where bond yields are concerned?
Well, I think at the 10-year point, which is possibly the most important from the RBI, and which is possibly most important even from analyst perspective like ourselves, uh, I don't think the 10-year is moving anywhere. And the clear indication from the RBI's perspective is that I'm going to hold this level as long as I can. And that's possibly the reason why RBI today owns almost 70% of this 10-year paper.
Hmm,
Now, the contextual importance over here is how much of your loans are priced out of the 10-year. Now, the point that I'm trying to make is that whether the belly of the curve, which is, for example, the 2-year and the 5-year, that will start moving up because there will be a huge amount of pressure from the government in terms of the borrowing. The states have not really borrowed to the same extent that they had planned to in the first quarter. So those all will get added to the second quarter and the third quarter. Whether those pressures actually build up, which necessarily means that the RBI will also have to shift out from the 10-year or looking at the 10-year to doing a lot more open market operations and management of even the 2 years and the 5 years. So this actually brings back to the whole issue of whether there is any normalization from the RBI in whatever ways possible, or even from the central banks world over, whether there is any normalization possible at all in the current scenario.
Mm,
And the bigger issue, therefore, is if I allow interest rates to rise, whether that actually has a debilitating impact on debt, not only for the government, but also for individuals like you and me.
mm,
Because then, as my loan rate reprices itself, with visibility of future income streams being weak, that in itself might once again crimp my consumption behavior,
mm.
rather than doing anything else. So I'm more or less sure that for the next 12 to 18 months, actually, yes, there can be some tinkering on the amount of base liquidity that is there, but I'm sure that the RBI is not going to normalize rates at all and create any pressure on the system, from the sort of generalized interest rates in the economy.
Right. And very lastly, Mr. Pan, overall, with all the measures that the RBI has announced with regards to liquidity, where they're extending liquidity to intensive sectors, to SIDB, they've increased the exposure limit for Resolution Framework 2.0. And if you talk about the extension of PLI schemes, supporting the MSMEs, will all of this somewhere put some bit of pressure with regards to where the fiscal deficit is concerned? How would that scenario pan out?
Uh, Fiscal deficit, too early to comment on the fiscal deficit for this year,
Hmm,
but I'll give you my broad take on
hmm,
this. One, the fiscal would possibly be benefited by the 40,000 crores additional fund infusion from the Reserve Bank of India. Second, yes, there could be some slippages on the disinvestment side and also from the tax revenue if the growth perspectives don't pick up that much significantly. Or the other way to look at it is you might not also. So the reason I say that it's too early to talk about the revenue stream is because whether we are looking at a 10% GDP and a 4% inflation, which gives me 14% nominal growth, or am I looking at an 8% GDP and a 6% inflation, which still gives me a 14% nominal growth? So, given the fact that the revenue stream will be dependent on how your nominal growth is rather than purely your real growth, the revenue side of the picture may not be changing very significantly. And if you remember, clearly the government had been relatively more conservative in taking the revenue estimates than in previous years, and
hmm.
that's the good thing that they have done. The other part of it is why I say it's too early to talk about the fiscal and whether it will hit back on your borrowings program, etc. Is that the small savings collections that they have targeted for this year in the budget is lower than the actual collections in the last year. And if my bet is that interest rates are not going to move, my 1 year FD points for, say, various banks in India are not going to move up, which necessarily means that given the advantage of higher interest rates with the small savings schemes, people might once again continue to pile up into the small savings rather than relying on bank FDs if they are investing in debt instruments at all. So the implication of this is that they will once again get a buffer of a higher collection through the small savings, which will help balance out any higher fiscal deficit.
Right. So do you,
Therefore,
yeah,
therefore
sorry, go on.
fiscal deficit may be higher,
Hmm.
but that might not translate into additional borrowings of the central government.
Right. But so do you think there could be a possibility of a shift that could happen from a capex expenditure to a revenue expenditure?
Immediately, I don't foresee that because if you really look at the capex and expenditure, not only from the budget perspective,
Hmm.
but budget plus extra budgetary, that has just grown about 4%, which does not beat even inflation in this current year. So I don't think the government will take that risk and shift capex out, because that would have a much more severe implication on growth, and not only that, even on their revenue generation targets. So they will not do that, in my opinion.
Right. And very lastly, my last question would be on the outlook with regards to where credit growth is concerned, because overall, if you go to see, there has been a significant amount of deleveraging by the stressed sectors. They've issued bonds at low cost. However, no one is really willing to invest in this uncertainty. So how do you see that impacting credit growth on an overall basis?
Well, to a certain extent, I think credit growth, as you rightly said, the credit growth for capex building is possibly missing today. And people who might also be wanting to put up capex, they possibly have their own cash surpluses to invest in, rather than sort of going to the banks and raising the money. The other perspective is, given the low rates of interest in the money market, raising funds out of the money market has possibly become much more cheaper than raising funds out of the banking sector, and that is where I think the credit growth is suffering to a very significant extent. Now, the extent to which credit growth might pick up is if we are expecting that there is no third wave. Services sector credit growth could be picking up, because services sector would actually need a lot of money, even to sort of restart and bring themselves back within the economic cycle that they were in before the pre-pandemic days. So that's one area. The second is working capital needs, because input costs have relatively been on the higher side, both from the inflation perspective and also the global metals price or commodities price perspective. So some of the credit growth will happen in those areas. The other area, of course, is the personal credit growth, which to a certain extent has been seeing a relative uptick. But I think one needs to be very careful about how we look at this data at this point in time, because we have this COVID book where banks have been allowed to lend for personal medical expenses, etc. So the point that I'm making is that this type of credit growth might actually not have any productive beneficial impact so far as growth is concerned, because ultimately these are spent for medical expenses, which is more like a current expense than anything else.
Right. All right, Mr. Pan, thank you so much for sharing that candid conversation with us and great insights. I hope you enjoyed the conversation as well. Thank
Thank you.
you.
Yes,
Stay
I did.
safe
Thank you.
and speak to you soon again.
Sure. Thank you
Thank
very much.